With the U.S. market now closed for the weekend, Virgin Galactic Holdings, ticker SPCE, ended Friday's session on November 7th at 3.59 USD. It was an exceptionally quiet day on the surface, with the stock adding just half a cent, a fractional 0.14% gain. In after-hours trading, it tacked on another penny, resting at $3.60. But this stillness is deceptive. The market isn't being quiet because it's bored. It's being quiet because it's holding its breath. The entire investing community, from the long-term holders to the aggressive short sellers, is bracing for one thing: the company's third quarter 2025 financial results, scheduled to drop next week on Thursday, November 13th. This flatline price is the textbook definition of a market coiling before a major news event, and it perfectly masks the intense battle raging underneath the surface. The general belief, the one that has drawn so many investors to SPCE, is that this is a ticket to the future, a high-growth, aspirational play on the final frontier of tourism. The expectation is built on stunning videos of the VSS Unity, billionaires floating in cabins, and the promise of a new age of commercial spaceflight. The reality, however, is something entirely different, especially right now. The reality is that Virgin Galactic is, at this moment, a grounded company. It isn't flying. Commercial operations using the Unity spacecraft were deliberately paused to conserve cash and pivot the entire company's focus to building its next-generation fleet. So if you're looking at SPCE as a company generating revenue from spaceflights today, you're looking at the wrong story. The real story is one of heavy development, massive cash burn, and a race against the clock. Friday's trading session, as seen in the intraday chart, was a microcosm of this anxiety. The stock opened at $3.50, but it didn't find support there. It was quickly pushed down by sellers, hitting a low of $3.35 in the first couple of hours. This is the anxiety of the bears, the ones who see the cash burn. But from that 12 p.m. low, buyers stepped back in, driving the price all the way up to a high of $3.61 by late afternoon, before it settled. This tug of war between $3.35 and $3.61 shows a market in perfect disagreement. Neither the bulls nor the bears wanted to commit to a major position ahead of next week's report, leading to that tiny half-cent gain on what was likely anemic volume. It's a placeholder day, but the tension is palpable. Now let's talk about the element that is defining this stock far more than the daily news: the significant and entrenched short interest. This is not a casual bet against the company. It's a structural feature of the stock. As of the most recent data, the short interest as a percentage of the free float for SPCE is sitting at a very high 18.18%. That means, for every 5 shares available to trade, roughly one of them is a short. Over 10.4 million shares are currently sold short. This is an enormous position, and it's expensive. The cost to borrow, or the fee that short sellers have to pay to borrow shares, is hovering between 9.5 and 10.2%. To put that in perspective, a typical stable blue-chip stock might have a borrow fee of 0.5% or less. A 10% fee is a significant headwind, meaning short sellers are paying a hefty price for their bet. They must be extremely confident in their thesis to maintain that position. Their thesis is straightforward and, frankly, not without merit. They are not betting against the idea of space. They are betting on the balance sheet. They see a company that reported a Q2 net loss of $67 million and is projecting a free cash flow burn for the third quarter, the one we're about to get, of between $100 and $110 million. That is an astounding amount of cash to burn in 3 months for a company with a market cap of just over $2 billion. The short thesis is that SPCE is in a race to get its new Delta-class ships flying before it runs out of cash, and that it will have to keep diluting shareholders to survive. And they have a point. Over the last year, total shares outstanding have grown by a staggering 99.4%. The company has been funding its operations by printing new shares, effectively cutting the pie into smaller and smaller slices for existing owners. For retail investors, it's crucial to understand how to track this. You can find short interest data on platforms like Fintel or S3 Partners, which often report it. The borrow fee is a live metric you can see on most sophisticated broker platforms. An important and often overlooked piece of data is the off-exchange short volume. On November 6th, the off-exchange short volume ratio was nearly 60%. This suggests that a large amount of the shorting activity is happening in dark pools, away from the lit public exchanges, which can be used to mask selling pressure. Another data point to watch is the fail to deliver, or FTDs. While recent FTD numbers from September aren't at crisis levels, there were notable spikes of over 82,000 shares failing to deliver on one day and 43,000 on another. Persistent FTDs can sometimes be a signal of market stress or unusual borrowing activity, and it's something the retail community on forums like Reddit watches very closely. What's your take on that 18% short interest? Is it justified pessimism from institutions, or are they underestimating the Delta fleet? The other side of this structural coin is the ownership profile. If the shorts are institutional, who is holding the long side? The answer is overwhelmingly retail investors. Institutional ownership in Virgin Galactic is remarkably low, at only about 15.7%. The general public, or retail, holds the vast majority at around 84%. This is a classic retail-dominated stock. While major players like Vanguard, BlackRock, and Citadel do have positions, they are, for them, tiny speculative stakes. This retail-heavy ownership explains the stock's volatility and its sensitivity to social media sentiment. But it also means that the smart money is, by and large, sitting on the sidelines, waiting for proof. So, what is the business, and what is this proof everyone is waiting for? Virgin Galactic is a pioneer in suborbital space tourism. Its original vehicle system, VSS Unity, completed several successful flights, taking paying customers and researchers to the edge of space. However, management made the hard and controversial decision to retire Unity and pause all commercial flights. Why? Because Unity, while a technical marvel, was not a financial one. It was not designed for the high-frequency, rapid turnaround flight schedule needed to run a profitable business. The entire future of the company now rests on the successful development and deployment of its next-generation Delta-class spaceships. These Delta ships are the core of the bull case. They are being designed to fly up to 8 space missions per month, a 12-fold increase in capacity over Unity. They are the vehicles designed to actually make this a real business. The company is currently building its Delta facility in Arizona, and the timeline is everything. The expectation is that the first Delta ships will begin commercial service in 2026, with flights commencing in the fall of that year. To get there, the company has to hit several key milestones, including the completion of the wing and feather assemblies in the fourth quarter of this year and the fuselage in early 2026. This brings us back to next week's earnings call. No one is expecting significant revenue. The number everyone will be looking at is the cash burn. Did they burn the expected 100 to 110 million, or was it more? Did they manage to conserve cash? And second, and far more importantly, is the 2026 timeline for the Delta fleet. Any hint of a delay, any word of a slip in the Q4 milestones will be punished severely by the market and will give immense confidence to the short sellers. Conversely, if they confirm the timeline, beat the cash burn expectations, and show tangible progress on the Delta hardware, it could put the shorts in a very difficult position, especially with borrow fees that high. Comment below what you think the most significant risk for Virgin Galactic is, the cash burn or the 2026 timeline. Looking at the analyst community gives us no comfort. The forecasts are all over the map. The average 12-month price target is 4.14, but the range is from a low of $2 to a high of $8. This is the widest possible dispersion, reflecting total uncertainty. The analysts at Bernstein and Morgan Stanley remain deeply pessimistic with underperformed ratings, while Jefferies holds on to a buy. This isn't an investing story. It's a belief story, and no one agrees. So as we head into this critical week, the expectation versus reality frame for SPCE is clearer than ever. The public expectation is of a futuristic space company taking people to the stars. The reality is that this is a pre-revenue development company, functionally a startup, with a massive 18% short interest betting against its balance sheet. It's a binary bet. The stock is holding at $359 not because that is its true value, but because the market has reached a state of perfect paralysis. The tension is between the dream of the Delta fleet in 2026 and the nightmare of the quarterly cash burn. Next Thursday's earnings call is not just a financial update. It's the event that will tell us which of those two realities is winning.